Good afternoon, and thank you for joining us today. My name is Hussein Adatia, and I'm a portfolio manager on the multi-asset income team. I want to spend a few minutes today with you reviewing July 2025 performance and giving an updated outlook for the remainder of 2025. July 2025 was a strong month for risk assets, with equities leading the way. Tech and growth stocks were the standouts, with the Russell Growth Index up 3.8% and the NASDAQ up 2.4%. Tech outperformance was driven by a very strong earnings season, with Microsoft, Meta, Apple, and Alphabet all posting great results. These companies showed strong revenue growth, great operating margins, and good outlooks, all while investing tens of billions of dollars in the AI opportunity. On the credit side, July was more of a mixed bag. Interest rates backed up 15 to 25 basis points across the credit curve, but this was more than offset by spread compression in corporate credit. Investment grade spreads declined 8 basis points during the quarter, and high yield spreads declined 11 basis points. Putting it all together, investment grade bonds returned a positive 15 basis points for July, while high yield bonds returned a positive 40 basis points for the month. Turning to the next slide, we're taking an even more granular look at what drove equity returns for the month. As previously noted, big tech was a standout, with utilities and industrials not far behind. On the flip side, consumer staples and healthcare underperformed, and this was driven primarily by weaker earnings as well as higher interest rates during the month. On the next slide, in credit, shorter duration bonds outperformed longer duration, which makes sense given the move that we saw in interest rates. And in high yield, lower rated bonds, single Bs and triple Cs, outperformed higher quality, which is to be expected given the strong performance of equity markets during the month. Now, turning to our outlook, we've developed 3 different investment cases to account for a wide range of economic scenarios. In our base case, we expect modest economic growth, slowing inflation, and a resilient consumer. For the year, we're expecting 2 interest rate cuts and steady corporate earnings. In our upside case, we project additional rate cuts, lower inflation, and more global growth, all of which should help propel the US economy even higher. In our downside case, we project upside inflation surprises coupled with trade wars and a slowing US economy. In short, a hard landing. So where does that leave us on asset allocation? At the end of July 2025, we remain neutral on equities. We believe corporate earnings will remain strong, but equity multiples are elevated. We have a slight negative bias towards credit. Presently, high all-in yields are very attractive, but this is offset by very tight credit spreads relative to historical benchmarks. We are neutral on duration, as we expect the yield curve to steepen, as interest rate cuts will push down the front part of the yield curve. However, inflation concerns as well as soaring US budget deficits make us a little less enthusiastic about the long end of the curve, which we've seen during the course of July and August so far. And finally, to wrap up, our chart of the month. Here, we are depicting 2025 growth expectations for the US economy. As you can see, we've rebounded off the Liberation Day lows from April 2025, but in that same time, equity markets are up nearly 30%. And that begs the question, have we come too far too fast? Thanks for joining in today. Please reach out to your Westwood advisor or any member of the Westwood multi-asset team should you have any questions.